I genuinely think I need a second or maybe even a third cup of coffee today just to process the absolute mess of conflicting market signals flashing across the screen this week.
Yeah, it's definitely been a heavy data week for sure.
It really is. I mean, you look at the charts and macro data, and they're just pulling in entirely different directions right now. Welcome to Inside Bitcoin. For today's deep dive, we're unpacking a really bizarre, fascinating week. We are looking at May 4th through today, May 8th, 2026.
Right, and there is just a massive amount to cover. You've got geopolitics, macro data, and some really wild on-chain drama.
Exactly. And just to set the stage for you listening, this research comes from Mo and Moestradamos research team. Our mission today is really to figure out how geopolitical tensions, these unprecedented on-chain governance standoffs, and, well, the actual underlying infrastructure of crypto are all colliding.
Because it's a labyrinth out there right now. You have the structural price action reacting to macro events on one hand, and then entirely independent technological battles happening on-chain on the other.
Right. Which is why if you only look at the price of Bitcoin, you miss the actual evolution of the architecture. But let's actually start by dissecting that price action, because Bitcoin hit a pretty serious wall this week.
It did, yeah.
We watched the price hit $77,000 on May 7th, pushing up, but then it slipped back below that psychological $80,000 mark, settling at around $79,000 today, May 8th. And we are seeing a confluence of things here. There's the escalating global tensions, specifically the ongoing developments with the Iran conflict, which is pricing a geopolitical risk premium into the market.
Yeah, the geopolitical risk is a huge factor. But the data also shows a massive wall of profit-taking that's stalling out the momentum of the recent Trump rally.
So let's unpack that. What does that exhaustion actually look like on a structural level?
Well, when we talk about the so-called Trump rally, we are talking about a specific market narrative, right? It drove massive momentum and expectations of a potentially deregulatory environment. But, momentum eventually meets mathematics. And we can see on-chain that older coins' unspent transaction outputs that haven't moved in, say, 6 to 12 months, they started moving to exchanges.
Oh, wow. So that is the physical manifestation of a profit-taking wall.
Exactly.
Yeah.
Traders who accumulated positions at lower levels, they look at the geopolitical uncertainty with Iran, they look at their unrealized gains, and they systematically begin to lock them in.
Which makes total sense.
Yeah.
It's like runners hitting the wall in a marathon. The momentum was there, the crowd was cheering, but eventually the sheer realization of those gains, just the physical exhaustion of the market, takes over.
Yeah, the market absorbs that selling pressure until the order books thin out, which is exactly what caused that friction right below the $80,000 level.
But I want to push back on the specific derivative mechanics of this pullback, because it wasn't just a quiet slip. As Bitcoin settled around 79,000, we saw negative funding rates hit a 10-year record.
Yeah, that was a massive anomaly.
And interestingly, DOGE led the major losses across the broader market. So for anyone listening who isn't actively managing a perpetual futures portfolio, explain what a negative funding rate actually physically means for the order books. Like, is a 10-year record a sign of a structural reset or just an overreaction by leveraged traders getting shaken out?
To understand the severity of a 10-year record, you really have to look at the mechanics of perpetual futures contracts. So unlike traditional futures, which expire on a specific date, perpetuals run forever.
Right, they never expire.
Exactly. So to keep the price of the perpetual contract anchored to the actual spot price of Bitcoin, exchanges use a funding rate. Every 8 hours, an automated payment is calculated. If the funding rate is positive, traders who are long, meaning they're betting the price will go up, they pay a fee to the traders who are short.
But when the funding rate goes deeply negative, that dynamic flips.
Right. The shorts are paying the longs.
Which means the market is overwhelmingly betting on the price to drop.
Precisely. A 10-year record negative funding rate indicates a violently crowded, highly aggressive short bias. It means people were so desperate to bet against Bitcoin at $79,000 that they were willing to pay unprecedented, exorbitant fees every 8 hours just to keep their short positions open.
That's wild. But does that mean the bottom is falling out?
Not necessarily. Historically, when the pendulum swings that far to one extreme, it is rarely a sign of permanent structural demise. It is almost always a sign of a highly leveraged, top-heavy market getting flushed out. The market seeks maximum pain. And the fact that DOGE led the losses is the ultimate tell here.
Because DOGE functions as a high beta asset for the retail market, right?
Yeah. Let's define beta in this context for the listeners. Beta is a financial metric that basically measures an asset's volatility relative to the broader market baseline.
So if Bitcoin is the baseline with a beta of 1, a high beta asset moves with significantly more aggression.
Exactly. If Bitcoin drops 3%, a high beta asset like DOGE might drop 10 or 12%. Retail leverage tends to congregate in those assets because traders are seeking maximum percentage gains.
Right.
So when you combine a 10-year record negative funding rate with a massive flush in a high beta asset, you are looking at a classic liquidation cascade. The excessive leverage is violently removed from the system.
Which actually creates a healthier foundation for the market moving forward.
Exactly. It's a reset.
So while the crypto markets were busy flushing out leverage and taking a breather, traditional equities were practically throwing a parade.
Yeah, completely different vibe.
Today, May 8th, broader traditional markets surged. And that was largely driven by the release of the April jobs report and the market digesting those ongoing Iran conflict developments. But simultaneously, we had reports yesterday, May 7th, of a major shift in worldwide cryptocurrency regulations. It feels like a complete decoupling between traditional finance and digital assets this week.
It is a decoupling, and it's driven by how different pools of capital interpret macroeconomic data versus, industry-specific headwinds. Traditional markets looked at the April jobs report and saw economic resilience.
Strong non-farm payrolls suggest the consumer base is healthy.
Right, which eases fears of an immediate deep recession. Traditional investors priced in the geopolitical risks, digested the strong labor data, and deployed capital into equities. But digital assets had a completely different set of weights tied around their ankles. The simultaneous influx of global regulatory shifts completely overshadowed the macro data.
I have to push back on that prevailing narrative, though.
Okay, sure.
Because if crypto is historically touted as the ultimate hedge against traditional market instability and state intervention, why did it react inversely to traditional markets on this specific macroeconomic news? Shouldn't global regulatory crackdowns and geopolitical tension be the exact environment where a decentralized asset proves its whole thesis?
Well, it's the core paradox of institutional adoption, honestly. You get their liquidity, but you also inherit their risk models. In theory, yes, a decentralized asset should thrive when traditional systems look authoritarian or shaky, but you have to analyze who is actually moving the market at these price levels.
It's not just retail holding keys on hardware wallets anymore.
Not at all. The trading volume is heavily driven by algorithmic trading desks and institutional quantitative funds. These algorithms parse news headlines via APIs. When a massive global regulatory shift is announced, those algorithms don't read the foundational philosophy of Bitcoin.
They just register an increase in a parameter called compliance risk.
Exactly. Automatically and instantly. The algorithmic models treat digital assets more like high beta technology stocks than digital gold. If compliance uncertainty increases, the models mathematically reduce exposure to protect capital.
So the long-term thesis might be totally fine for the holders, but short-term, the machines are selling.
Right. The short-term price action you are seeing on the screen is dictated by the rigid programmatic risk models of institutional liquidity providers.
Which is a really fascinating transition because it's not just traditional governments flexing their regulatory muscles from the outside. We are witnessing a massive philosophical clash happening directly on-chain right now.
Oh, the Arbitrum situation.
Yes. Let's look at this ecosystem drama. Today, May 8th, Arbitrum formally approved a highly contested $71 million ETH release. And they proceeded with this transaction despite an active U.S. asset seizure fight.
Yeah, this is arguably the most consequential legal and technological drama of the week.
I look at this and I just see unstoppable code meeting an immovable legal object.
That's a great analogy. To fully grasp what is at stake here, you have to understand the architecture of a decentralized autonomous organization, or a DAO. Arbitrum operates as a DAO.
Yeah.
That means there is no CEO, there's no board of directors, and no traditional corporate headquarters. Governance decisions are made by token holders voting on proposals. If a proposal reaches the required threshold, the smart contract automatically, deterministically executes the code.
It's basically a digital vending machine. You put the correct input in, the community votes yes, and the machine drops the output. The machine doesn't care about the news, and it definitely doesn't care about court orders.
Exactly. And in this specific case, the community voted to execute a $71 million ETH release. But the friction arises because traditional legal frameworks are completely incompatible with this architecture. There is an active U.S. asset seizure effort targeting these specific funds.
But the whole premise of the traditional legal system is built on centralized choke points, right?
Right. If the government wants to seize an asset, They issue a subpoena or a court order to a bank or an exchange. A human being at that institution reviews the legal document, logs into the centralized database, and freezes the account.
But how can a decentralized entity theoretically comply with a seizure order without fundamentally breaking the immutable rules of its own smart contracts? I mean, if Arbitrum developers step in and freeze the release, don't they instantly destroy the trust that the network is actually decentralized?
They do, and that is the paradox. A true DAO physically cannot comply with a traditional seizure order because the architecture just does not possess a centralized pause button.
There's no admin key.
Right. To halt that transaction, the developers would have had to build in an admin key, a backdoor that overrides the community vote. If you have an admin key that can freeze funds to comply with a subpoena, you are no longer a decentralized protocol. You are effectively a centralized fintech company operating a really inefficient database.
Wow.
So by allowing the $71 million release to execute, Arbitrum functioned exactly as its open source code dictated. But in doing so, it has drawn a massive line in the sand.
Yeah.
It is testing the outer limits of how state power can enforce legal mandates on decentralized autonomous code.
And if autonomous code cannot be governed by human subpoenas, we are moving into a system governed purely by the algorithms themselves, which logically leads us to exploring who, or rather what, is going to be utilizing that autonomous code.
The AI transition.
Exactly. According to Mo's research, AI agents are currently being positioned as the ultimate solution to the notoriously terrible user experience that has plagued crypto for over a decade. Today, May 8th, we saw major discussions regarding this convergence of Web3 and AI. Plus, Coinbase is apparently opening an entirely new battlefield specifically tailored for AI agent payments.
Yeah. The user experience in digital assets is historically abysmal.
It really is.
To execute a complex decentralized finance transaction right now, a user has to secure a seed phrase, fund a wallet, calculate variable gas fees, bridge assets across different blockchain networks, ensure they are interacting with the correct non-malicious smart contract addresses.
And manage slippage tolerances on top of all that.
Right. It is highly technical, deeply intimidating, and incredibly prone to human error. AI agents change this paradigm completely.
So what does that interaction actually look like under the hood, like practically speaking?
You transition from manual execution to an intent-based architecture. Instead of clicking 20 different buttons, you simply provide a natural language prompt to your AI agent. You say, take $500 worth of my USDC, find the most secure yield across the top 3 Ethereum lending protocols, and deposit the funds.
And the AI just does it.
The AI agent autonomously parses the state of the network, calculates the optimal routing path, manages the gas fees natively, constructs the transaction data, and submits it for execution.
Okay, and where does Coinbase fit into this?
Coinbase entering the space to facilitate AI payments is critical. They are building infrastructure, utilizing multi-party computation or MPC wallets, allowing AI agents to hold balances and autonomously transact with other machines. We are building the foundational rails for a literal machine-to-machine economy.
I understand the convenience, absolutely, but I have to push back on the philosophy here.
Okay, let's hear it.
If we hand over the keys and the decision-making to AI agents just to make the UX smoother, doesn't that fundamentally defeat the don't trust, verify ethos that Web3 was built on? I mean, if a proprietary black box AI algorithm routes my transaction through protocols I haven't audited, how do I maintain my financial sovereignty? Haven't I just traded a traditional bank manager for an artificial one?
It is the most critical philosophical tightrope the industry is walking right now. If the AI is just a closed-source black box operated by a centralized tech giant, then yes, you have entirely reintroduced trust into a system designed to be trustless.
Exactly.
But the counter-argument, and the mechanism developers are actively building out right now, relies heavily on zero-knowledge proofs to create verifiable AI.
Okay, we need to break that down because zero-knowledge proofs, or ZKPs, sound like absolute cryptographic magic to most people.
Yeah.
How do you mathematically prove that an AI executed your intent without actually reviewing all the data it processed?
The most accessible way to understand a zero-knowledge proof is the bouncer analogy. Imagine you want to enter a venue, and you need to prove to the bouncer that you are over 21. But you do not want the bouncer to know your exact birth date, your home address, or your name.
Right, you want privacy.
With a ZKP, you effectively walk up to an opaque machine. You slide your ID into the machine. The machine cryptographically scans the state-issued signature on your ID and simply flashes a green light to the bouncer. The bouncer gains zero new knowledge about your identity, but receives absolute mathematical certainty that the statement, "this person is over 21, is true.
Okay, I follow that. So how does that apply to an AI agent making a trade for me?
When applied to verifiable AI, the AI agent constructs your complex transaction and generates a zero-knowledge proof alongside it. This cryptographic proof guarantees that the AI executed the transaction exactly according to your defined parameters, without hallucinating or routing funds maliciously. Your wallet verifies the proof in milliseconds before signing. So the goal isn't to remove verification, it's to cryptographically automate the verification process. The user gets a seamless Web 2 style experience backed by ironclad Web 3 security guarantees.
That is a staggering technical leap. And while we are exploring the invisible mathematics governing these networks, let's look at the baseline infrastructure that is quietly upgrading in the background right now. Because we have two very different examples of real-world utility hitting the news this week.
Right.
First, Zcash announced they are rolling out quantum recoverable wallets within a month, with the explicit goal of becoming fully quantum-proof by 2027. And on the entirely opposite end of the spectrum, we have reports that stablecoin card spending is growing by a staggering 100% year over year.
These two data points represent the two necessary divergent pillars of a maturing digital ecosystem. You have extreme long-term defensive security and massive immediate retail utility.
Let's look at Zcash playing long-term defense first.
Right, so the threat of quantum computing is an existential, albeit slow-moving threat to modern cryptography.
Because right now, almost all digital security, from Bitcoin to traditional banking, relies on elliptic curve cryptography or RSA algorithms.
Correct. Classical computers operate in binary bits, zeros and ones. It would take a classical computer millions of years to brute force the prime factorization required to break modern encryption. But quantum computers use qubits, which can exist in a state of superposition, representing 0, 1, or both simultaneously.
Meaning they are exponentially faster at specific math problems.
Exactly. A sufficiently powerful quantum computer running what is known as Shor's algorithm could slice through modern elliptic curve cryptography in hours.
Which introduces that whole harvest now, decrypt later attack vector.
Yes, exactly. Adversaries, including state-sponsored actors, are currently recording and storing massive amounts of encrypted internet traffic. They can't read it today, but they are hoarding it for the day a quantum computer comes online.
That is terrifying.
By rolling out quantum recoverable wallets now, Zcash is implementing a migration window. They are allowing users to transition their funds to post-quantum cryptographic standards. Things like lattice-based cryptography, which relies on complex, multidimensional grid mathematics that even quantum computers struggle to navigate. They are future-proofing the network's privacy infrastructure against a technological threat that is likely still 5 to 10 years away.
And then on the other side of the utility spectrum, you have stablecoin debit cards, which function as the ultimate Trojan horse for mainstream adoption. I mean, 100% year-over-year growth in card spending means this isn't just speculation anymore. This is daily commerce.
It is stealth adoption in its purest form. When a user swipes a stablecoin card at a grocery store, an incredibly complex sequence happens in seconds.
Right, because the cashier doesn't know it's crypto.
Exactly. The payment terminal pings the Visa or MasterCard network. The card issuer instantly authorizes the transaction, programmatically liquidates the exact required amount of USDC stablecoins from the user's wallet into fiat currency, and settles the merchant in traditional dollars.
The merchant has no idea a blockchain was involved.
The user doesn't have to worry about the capital gains taxes or volatility of spending Bitcoin. The blockchain is simply functioning as an invisible, hyper-efficient back-end settlement rail.
So stablecoins capturing the payments layer and AI agents capturing the user experience are dominating the headlines right now. But interestingly, when we analyze the data for this specific week, May 4th through the 8th, the DMT, or Digital Matter Theory, and Ordinal's ecosystem had a remarkably quiet week.
Very quiet.
There were no massive announcements, no dramatic drops, which honestly makes it the perfect time to look under the hood. When the hype cycle pauses, that is usually when you can see what the engineers are actually building.
Exactly. A quiet week in price action almost always correlates with a high-velocity week for development. To really understand the foundation being laid in the digital matter theory space, we need to dive deeply into the underlying mechanics. The foundational concept of DMT is the creation and structuring of non-arbitrary digital real estate directly on the Bitcoin base layer.
And for you listening, we really need to clarify the terminology here to ensure this makes sense. When we talk about mapping this data, we are talking about bitmap, as in bitmap, Bitcoin block mapping. I know it can sound like dense technical jargon, but it is a crucial distinction to make.
Very crucial.
So during these quiet weeks, what structural foundations are developers actually building? How does block mapping genuinely anchor value compared to a developer just typing out a new token supply on a generic smart contract?
The concept of non-arbitrary data is everything here. When a developer launches a traditional token on most alternative networks, the parameters are entirely arbitrary. They simply write a line of code that says, create 1 billion tokens. The asset is conjured out of thin air. Bitcoin block mapping, or bitmap, flips that paradigm. It utilizes the inherent, immutable data structure of the Bitcoin blockchain itself to generate digital matter.
Because every single Bitcoin block is a unique cryptographic fingerprint.
Exactly. Every block contains a header with highly specific data. The block height, the timestamp, the mining difficulty target, the nonce, the transaction fees paid, and the volume of data inside the block. What digital matter theory proposes is that you can take these immutable, historically proven characteristics and use them as spatial and structural parameters.
So a bitmap isn't just a random picture of a grid.
No, it is a permanent spatial coordinate system tied to a specific Bitcoin block.
Okay, so explain how a parser actually reads that data to create something tangible.
Think of a parser as a translation engine. Developers are building software that looks at the hex data of, say, Bitcoin block 400,000. The parser uses the data from that block to generate a 3D topology.
Oh, I see.
The transaction fees paid might dictate the height of digital structures within that space. The specific nonce found by the miner might dictate the atmospheric conditions or the color palette of the terrain. The timestamp anchors it in historical time. By inscribing this mapping onto the Bitcoin base layer using the ordinals protocol, which allows arbitrary data to be attached to individual Satoshis, developers are claiming verifiable digital real estate.
And the value is anchored because that specific block required massive, real-world thermodynamic energy to mine.
That is the core differentiator. The digital landscape generated by a bitmap derives its properties from the proof-of-work security and historical reality of the Bitcoin network. No developer can ever change the height of the digital structures in block 400,000 because no entity on Earth possesses the computing power to rewrite the Bitcoin blockchain from 2016.
That's incredible.
So during these quiet weeks, developers are tirelessly building the parsers, the rendering engines, and the secondary layer 2 solutions that will eventually allow these mapped blocks to function as fully interactive, fully autonomous digital environments.
When you lay all of these pieces out on the table, the picture of what was built just between May 4th and May 8th is staggering. We have a market violently fleshing out excess leverage to build a stronger floor. We have a macro environment where institutional risk algorithms are actively clashing with global regulatory realities.
You have decentralized autonomous code standing its ground against traditional legal subpoenas.
Right. And quietly in the background, engineers are deploying quantum-proof cryptographic defenses and laying the infrastructure for autonomous AI agents to interact with mathematically proven digital real estate. Yeah.
The surface-level price action is always going to be the noise of human emotion reacting to immediate uncertainty. But underneath that volatility, the technological architecture of the digital economy is becoming radically more robust. It is becoming more autonomous, more resistant to centralized failure, and deeply integrated into both traditional retail commerce and highly complex digital environments.
Which leaves me with a final, slightly provocative thought for you to mull over. We spent time exploring how AI agents are being designed to flawlessly navigate the friction of Web3, routing transactions and utilizing verifiable cryptographic proofs. We also just explored how developers are actively building out this non-arbitrary digital real estate through Bitcoin block mapping, creating immutable digital topologies.
Yeah.
What happens when those two technological vectors collide? What happens when the AI agents we discussed earlier start autonomously interacting with, evaluating, and trading the digital real estate being mapped out in the DMT ecosystem? Imagine an artificial intelligence acting as a high-frequency digital real estate broker, moving at the speed of light to evaluate the spatial coordinates of Bitcoin blocks, negotiating with other AI agents, and settling transactions natively on the base layer. That is not science fiction. That is the very real future we are rapidly accelerating toward.
It's going to be fascinating to watch unfold.
If you want to continue the conversation and stay updated on Bitcoin price action and developments across the Bitcoin DMT ecosystem, check out the Discord link in the description or on the channel, where Mo will be sharing ongoing research, insights, and updates. We'll see you next time on Inside Bitcoin.